So with testing data, there are so many influencing factors, call it noise. How do you make your decisions when you are unclear about the noise factors? Basically, how do you defer from correlation to causality for bigger picture understanding? Or doesn't it matter because the only thing that matters is did it affect the expected value, positive or negative? Okay, so I don't like fully 100% understand the question, but I'm gonna try regurgitate back what I think this question means, which is after you test an idea, how do you know how good this idea actually is after the results come through? Because it could have just been it could just be showing you good results from pure luck, or it could genuinely have some kind of edge there. I think this is what this question is asking me, but I'm not 100% sure, but I'm just going to roll with that. Um, to the person who asked me this, if that's not what you asked, please just DM me again and clarify. But anyway, the answer to this is a validation test. So, okay, let me explain. Let's pretend that we come up with a strategy, which is like, let me use the text tool. If price closes, it is under the 97 moving average, and then it closes above it, get long, and hold the position for 30 candles, right? Let's just pretend this is our strategy, right? And then we go and look at the equity curve of this strategy. So this is the bankroll, and this is the trade number. And the bankroll looks something like this. It looks absolutely fantastic. An immediate mistake would be assuming that, oh my god, there must be something magical with this 97 moving average with where the close is after 30 candles. This combination is legendary and magical. It must work by default. So the thing is that it could have just been pure luck. It doesn't, just because we have a nice looking equity curve does not mean that we actually have edge, that just because there's something magical going on with these moving averages, with this specific exit. It could have just been luck. So an example, to prove that it's not luck, well, we can't like 100% ever prove it, but we can do something that's called a validation test. And the more validation tests your strategy passes, the more likely it is to actually have an edge, rather than for it to be pure blatant luck. I'm not gonna go through all like a whole bunch of validation test examples, but I'm just gonna give you one. And the one that I'm gonna give you is the neighboring parameter test. So the neighboring parameter test is, if we were to use a similar strategy to this, will it give us similar results? If the answer to that question is yes, then it passes the validation test. If the answer to that question is no, then it's very likely that the strategy is just giving pure luck results. Okay, so example. Let's say we test not the 97, but we also test the 96. How does the P&L look like? The P&L might look something like this. Huh, interesting. We test the, let's say, the 70. What about the 70? Does the 70 give us good results? And the 70 might look something like this. We're like, okay, interesting. Instead of going down, let's go up. Let's test the 120 moving average. And then we get results which might look a little bit worse, but it's still looking decent. If we have something like this, then we're getting closer to, okay, there might actually be something here. So we're going to test it with not just the entry, but we also want to test the exit. So it's like, okay, sure, 97 moving average, but what about if we exit slightly earlier after 25 candles? How does the P&L look like, right? So if we get something that looks like, let's say we test a whole bunch of different examples, and the equity curve of almost all of them looks something like this, Sorry, excuse me. Equity curve looks of all of them looks something like this. That means that this equity curve is just an outlier. This is not the average result of this particular idea. What a lot of traders get wrong is when they think about edges or trading strategies is they obsess about the very specific parameters that they are using to express their execution. But it's actually not about the parameters, right? It's about what is the fundamental premise of the idea. What is like the average results of the average idea? Like if we were to plot like 100 similar strategies to this, does the average strategy, if we were to tinker with it a little bit, make money? If the answer to that question is yes, then we've nailed something. You don't have to visualize this in with an equity curve. An alternative that you could do is do a bar graph. So we've got total P&L here, and then here we've got the parameter. Okay, so let me explain. So on the y-axis, we have the total results. Let's say this strategy after 100 trades, or let's say after 1 year, it made 100% return. So for a 97, if we use the 97 moving average, it would be at 100, right? Then the 96 moving average, let's say this one is at 10. And then the 98 moving average, this one is at like 12, right? So we could do it in the form of a bar graph with all the parameters for the entry. And then from there, we can look at the bar graph and we can spot what are the outliers. So if we have something like let me just draw this out a little bit. Whoop, what's happening? Okay. I'm just going to do a little bit there. Okay. And then if we were to plot a moving average through all of that, it would look something like this. Okay. So if we were to just say, okay, I want to just purely optimize for which parameters give me the absolute best results. What's going to happen? Well, we're just going to pick this one, whatever this parameter is. But the issue is it's not that this 100 or 97 moving average just happens to be magical. No, this is likely an outlier because the neighboring parameters don't actually do that well. If we want to optimize for what are the best parameters to use for the strategy, we want to pick the one where the neighbors are the top performing. So we want to pick for the cluster, for the best cluster of parameters, not the best isolated parameter. So here we have a cluster of good parameters, and here we can say, okay, if we wanted to optimize this strategy for the entry, just the entry, whatever this one is likely going to be the best one because there is going to be some margin of error here. So it means that, okay, if we used a slightly smaller moving average or even a slightly bigger moving average, the performance would still be pretty decent. Therefore, this one is probably the nicest one to use. But okay, that you would do this process for optimizing the entry and also for optimizing the exit as well. But this is just one example of a validation test. But the idea is that the more validation tests that you can pass, the more likely it is that you actually have an edge versus you were completely pure lucky. So on one extreme, it would be, oh, my strategy passed a back test. Like my strategy has a good looking equity curve on a back test. Congratulations, you passed the first validation test. That's one, right? That's literally one, right? But the more, so it could have maybe just been lucky, right? But the more of these validation tests that it can pass, the more likely it is that you have an edge versus it was pure luck, right? I'll make one other extreme example of something that passes like a massive validation test, and I'll actually circle back to one of the previous questions. Marketing. So let's say we have here a guy called Bob. Bob loses money as a trader. He loses 5% per month as a trader. He is a non-profitable trader, right? Then he goes on social media and he talks about trading. And then Bob somehow from social media, after talking about trading a whole bunch, he now starts making $5,000 a month, despite being a losing trader and not knowing anything about what he's talking about. After one of these instances, after Bob doing this, you might look at Bob and say, okay, well, Bob might just be lucky with whatever he's doing. He's just a silly guru on social media. He got purely lucky. It just is what it is. But then Timmy comes along, and Timmy is another trader who has some other style or method on, I don't know, equities. He talks about equities, and he's a losing trader as well. And he also makes $5,000 a month. And then there is another guy. This guy also is a losing trader. He loses 7% a month. But this guy manages to make $10,000 a month, right? Just because he has the skill of marketing. So it's like, okay, after one guy has the skill of marketing and he's making $5,000 a month from social media, you might say, okay, this guy's he's just lucky. Second guy, he's just lucky. Third guy, he's just lucky. Fourth guy, maybe they're all lucky. More than 100 or like 500 of these gurus exist who have no idea about anything with trading, but just because they have the skill of marketing, they're doing 4 to 5, even 6 figures per month in profit. So the logical conclusion that I get from this observation is that, okay, there must be some kind of edge with marketing, because like what the barrier of entry into this game is so absurdly low, to the point where like more than 100 of these guys can exist and continue to make upwards of this amount of money on a monthly basis. The fact that this is true and observable currently makes me believe that there is an edge there, and hence why I'm pursuing this goal, because I think that social media is heavily mispriced at the moment. But yeah, to answer your question, I hope that answered the question. You will need to run a validation test and basically stress test your strategy with different angles or different data sets to see, like, does it actually break under the stress, or does it break under additional pressure? The harder your strategy is to break, the more likely it is to have an edge. The easier it is to break, the more sensitive and more fragile the strategy is. Hope that answers the question. If it doesn't, remember, just send me a DM again about this, and I'll answer it.